Imagine looking at your own finances, going through everything, and realizing your debt has somehow doubled. Not over as your whole life, but just the last 10 years. It's quite a thought, isn't it?
It really is. Now imagine that, but on a massive national scale.
Exactly. And that startling picture, that's the critical financial landscape we're diving into today. India's household debt. We've pulled together some, honestly, eye-opening stuff to figure out what's going on beneath the surface here.
Yeah, our mission today is really to unpack the numbers, try to understand the forces at play, and figure out what it all means, for individuals and for the country's financial future.
We'll look at why this surge is happening, what's actually driving it, potential consequences, all that, but hopefully keep it engaging for you.
So let's start with the big picture, the headline fact.
Right. The most, astonishing thing, really, is that household debt in India has basically doubled in the past decade.
Doubled. It's a huge shift. Now, we did see a tiny dip recently, right? From maybe 42.9% of GDP in June 2024.
Yeah, down slightly to 41.9% by December 2024, but still, 41.9%. That's a number that definitely grabs your attention.
It does, and we need to put it in context. You might hear it's lower than the average for emerging markets, which is around 46.6%.
Okay, so maybe not the highest?
Well, yes, but think of it like a really tough race. Just because someone else is maybe struggling a bit more doesn't mean you're cruising. It's still a significant challenge.
That makes sense. So what does that 41.9% actually mean for people listening?
Okay, so think of it this way. For every single rupee the entire country produces, in terms of GDP, households owe almost 42 pays of that.
Wow. Okay, that really brings it home. That's a tangible sense of the pressure.
Exactly, that's a heavyweight.
Now, when you think about India and debt, often housing comes to mind. The property market gets a lot of attention. Is that what's driving this? Is it mortgages?
That's a really natural assumption. But interestingly, no. That's not the main story here. The primary driver behind this big surge, it's actually non-housing retail loans.
Non-housing. So what exactly falls into that category?
We're talking personal loans, credit cards, car loans, that kind of borrowing, often for, daily expenses, maybe some immediate wants rather than long-term assets.
And these aren't just a small part of the picture, are they?
Not at all. They are the picture, practically. As of March 2025, these non-housing loans made up a massive 54.9% of all household debt.
Over half. That's huge.
It is. More than half. It's not just growing, it's dominating. And the speed of growth is, well, explosive.
How explosive are we talking?
We're looking at a compound annual growth rate, the CAGR, of 20.4% just between March 2021 and March 2025.
20% growth per year, compounded.
Exactly. And just to compare, overall bank credit grew at about 14.6% in that time. So these specific loans are growing much, much faster.
That really paints a picture, doesn't it? It suggests a real shift in how people are spending, maybe borrowing, more of a buy now, pay later kind of thing.
It certainly looks that way. Borrowing for vacations, gadgets, maybe even just bridging gaps in daily life. It does raise questions about whether it's sustainable for personal finances long term.
So this brings us to a really interesting shift then. If non-housing is booming, what's happened to housing loans?
Right. That's the other side of the coin. Housing loans, which used to be the biggest chunk, have actually seen their share shrink quite a bit.
How much are we talking?
Well, back in fiscal year 19, they were around, say, 36, 37% of total household debt. By December 2024, down to 29%.
Okay, so a noticeable drop from over a third down to less than a third.
Precisely. So less debt is going towards what we typically think of as a long-term investment, like a home, and more seems to be flowing towards consumption.
And what does that signify, potentially?
It could mean a few things. Maybe changing priorities, or perhaps difficulties in the housing market itself. But it definitely suggests a change in where borrowed money is going.
There was also something interesting about who was taking out new housing loans, wasn't there?
Yes, this was fascinating. In March 2025, over a third, 33% of new housing loans went to people who already had a housing loan.
Really? So not first-time buyers necessarily.
Not always, it seems.
Yeah.
It makes you wonder, right? Is this for renovations? Or maybe second homes? It adds another layer to understanding these changing patterns.
So just to recap the breakdown, as of December 2024, housing is 29%.
Right. Non-housing retail loans, the big one, 54.9%. And then agriculture and business loans make up the rest, about 16.1%.
That 54.9% really stands out. It underscores just how dominant consumption-related borrowing has become.
Absolutely.
Okay, let's bring this down to the individual level again. What does this look like per person?
Well, on average, as of March 2025, each Indian owed about Rs 4.8 lakh,
4.8 lakh, and that's up from?
up from Rs 2.9 lakh just 2 years earlier in March 2023. So quite a jump in a short period.
And the surprising part here was who was doing the borrowing, right?
Exactly. This increase wasn't primarily driven by those struggling financially. It was largely led by higher-rated borrowers, people with good credit scores.
That seems counterintuitive. Why would people with good credit be borrowing so much more?
Well, it's a paradox. Maybe access to credit is just easier for them. Perhaps they feel more confident using debt. Or maybe, and this is a bit speculative, they're using that debt for investments, like in the stock market, hoping for higher returns, which adds a different kind of risk, of course.
And all this borrowing is happening against a backdrop of, well, something quite alarming on the savings front.
Ah, yes. This is really critical. Household savings, they actually hit a 47-year low.
47 years.
Yes, down to 5.3% of GDP in FY23. That is incredibly low.
And why is that so concerning? I mean, beyond just personal rainy day funds.
Because household savings are fundamentally what fuel investment in an economy. Think of it like this. If everyone's eating their emergency snacks instead of saving them, there's nothing left to plant for the future harvest.
Right. So less savings means less money available for businesses to invest, for infrastructure, for long-term growth.
Exactly. It's a fundamental imbalance.
Yeah.
You have rising debt on one side and falling savings on the other. That's a combination that definitely warrants attention.
So, okay, lots of borrowing, especially for consumption and less saving. The big question then is, are people managing to pay it back? Are we seeing warning signs, like rising defaults?
That's the million-dollar question, isn't it? And the answer is, well, it's mixed. It depends where you look.
Okay, break it down for us.
For the main banks, the scheduled commercial banks, the gross non-performing assets, NPAs, basically bad loans for consumer loans, were at 1.4% in March 2025.
1.4%? That sounds relatively low. Manageable.
It does seem manageable, yes. But when you look at the non-banking financial companies, the NBFCs, their NPA ratio for consumer loans is higher. It's 3.1%.
Okay, so more than double the rate at banks. Still, maybe not catastrophic.
Perhaps not overall, but there's a specific area of concern, credit cards. While overall delinquency might have improved slightly in some areas, defaults on credit cards are reportedly on the rise.
And credit cards are very accessible, often high interest.
Precisely. So rising defaults, there could be an early warning sign of stress, especially in a very visible part of consumer credit.
So the authorities, the Reserve Bank of India, they must be watching this closely. They're not just sitting back, are they?
Oh, absolutely not. The RBI has definitely taken notice, and they've acted.
What have they done?
Back in November 2023, they made a pretty significant move. They increased something called the risk weights for certain types of unsecured consumer loans.
Risk weights. What does that mean in simple terms?
Basically, they told banks and NBFCs that for every rupee they lend out in these specific categories, like personal loans or credit card debt, they have to hold more of their own capital aside as a safety buffer. They raised the requirement to 125%.
Ah, okay. So it makes those types of loans more expensive for the lenders to make, less profitable.
Exactly. It forces them to be more cautious. It acted like a bit of a speed bump, trying to slow down the rapid growth in these areas.
And did it work? Did it slow things down?
It seems like it did have an impact, yes. Reports suggest that retail loan growth did moderate after that measure was put in place.
So a regulatory tap on the brakes. But is it enough to prevent any potential future problems?
That's the big question, isn't it? It shows regulators are aware and proactive, but whether it's sufficient long-term, that remains to be seen. It's about balancing growth with stability.
And thinking long-term, what does all this mean for India's overall economic growth trajectory? I remember reading something from the Bank for International Settlements, the BIS.
Yes, that's a key piece of research. They looked at data from 1990 to 2015 across many countries.
And what did they find?
They found a pretty clear link. For every 1 percentage point increase in the household debt-to-GDP ratio, long-term economic growth tended to drop by about 0.1%.
Okay, so more debt equals slightly slower growth?
Yes, but here's the kicker. The negative effect gets much stronger if the debt ratio goes above 60% of GDP. Then it really starts to drag down growth more significantly.
And India is currently at 41.9%.
All right, so we're not at that 60% danger zone yet. But the trend is upward. It highlights why managing this debt level is important for sustained economic health. We don't want growth fueled only by potentially unsustainable borrowing.
But hang on, amidst all this concern about debt, there's another side to the story, isn't there? Something about financial wealth actually growing.
Yes, and this is the fascinating counterpoint. It's not all doom and gloom. Indians' financial wealth has been growing, quite strongly in fact, especially in fiscal year 24.
So while debt is up, assets are also up.
Broadly speaking, yes. And it's interesting to see where people are putting that wealth.
Where's it going? Still mostly safe options.
A large chunk, yes. As of March 2024, about 70% was still in things like bank deposits, insurance, pension funds, the traditional safe havens. Security is still clearly important.
But
But we're seeing a noticeable shift. More money is flowing into equities, into mutual funds. The share might still be smaller than deposits, but it's growing.
suggesting maybe a greater appetite for risk, or at least for potentially higher returns from the market.
Exactly. It suggests a growing financial sophistication, perhaps, among some segments. People are looking beyond just fixed deposits, even with the associated risks.
And one last crucial point. Who's actually doing the lending here? Where is most of this debt coming from?
That's important for understanding systemic risk. The vast majority, over 70%, comes from the scheduled commercial banks. The big banks?
Okay, and the rest?
The remaining chunk comes from cooperative banks, the MBFCs we mentioned earlier, and housing finance companies.
So the health of the major banking system is pretty closely tied to how well households manage this debt.
Absolutely. If things were to go wrong on a large scale with repayments, it wouldn't just be an individual problem. It could impact the stability of the core financial system. It highlights why the RBI is keeping such a close eye on it.
Right. So let's try and sum this up. We've got household debt in India clearly rising, driven hard by non-housing consumption type loans.
Yeah, while at the same time, household savings have hit this concerning multi-decade low.
And the RBI has stepped in with measures like those risk weight increases, acting as a speed bump to try and moderate the pace.
Exactly. It's a really complex, evolving picture. Lots of moving parts, changing consumer behavior, regulatory responses, shifts in investment preferences.
This deep dive, it really does make you think, doesn't it? Makes you reflect on your own situation. Are you borrowing wisely, saving enough, balancing today's needs with tomorrow's security?
It absolutely does. And that leads us to a final thought, maybe some food for thought for you listeners.
Go on.
Given this clear shift, we're seeing more appetite for market investments like equities, alongside this surge in borrowing for consumption. What does this really mean for that traditional Indian value of, saving diligently for a rainy day?
Is it being replaced by something else? A greater comfort with leveraging debt, maybe? Embracing market risk for potential reward?
Perhaps. Or maybe it's a more complex mix. But thinking about that balance saving versus investing versus borrowing in this new financial landscape, what choices would you make personally? Something to ponder until our next deep dive.